Welcome to Breaking News to Trading Moves.
Good to be here.
So, we've got a pretty specific headline on the desk today. It's about Chevron, that's ticker CVX. They beat their Q4 profit
They
expectations.
did, yeah.
And usually, when a company like Chevron beats earnings, the conversation kind of stops there at the numbers.
hmm
We look at the margins, the buybacks, maybe glance at guidance. And to be fair, the numbers were solid. I mean, record output, leaning heavily on efficiency.
It was a clean quarter, no doubt.
But if you only look at the spreadsheet, you sort of miss what's really driving things here. There's a narrative tucked inside this report that matters a lot more than just the profit beat.
You're talking about Venezuela.
Venezuela, exactly. Now, this is where we need to be really precise. Why does a comment from Chevron's management about Venezuela actually matter to the rest of the market?
Because it creates a new variable. I mean, the context here is that U.S. rules about Venezuela are, well, they're loosening up. It's a slow process, but it's happening.
And Chevron's right in the middle of it.
They're not just watching this happen. They are actively involved. They're already producing in the region.
Right.
But the commentary in this report, it suggests that output could rise. Well, meaningfully. If more authorizations come through, Chevron is positioned to ramp things up.
So what we're really talking about is the potential reintroduction of a major oil supply that has been basically suppressed for years.
Exactly. And in commodity markets, supply is the ultimate driver. When you introduce a new source of crude, especially the type of crude Venezuela produces, it just changes the math for everyone else.
Okay, which brings us to the plan for this discussion. We're going to look at how this new Chevron's performance plus this Venezuela factor creates a distinct set of winners and losers.
It creates a divergence, really. For some companies, this is a green light. For others, it puts a ceiling on things.
Let's start with the winners. You've pointed to three categories here. The first one is the U.S. supermajors, but you added a qualifier. You said supermajors with geopolitical optionality. What's that?
Right. It's really just a fancy way of saying they have the size and the connections to handle a mess.
A mess.
Well, yeah, Venezuela isn't a simple place to do business. If the country opens up, you can't be some mid-sized producer and just show up in Caracas expecting to drill. You'd get crushed.
Legally, financially.
Both. It requires massive scale. It requires legal teams that understand sanctions law just as well as they understand geology. The supermajors, they have earnings resilience. They can handle growth in places like Guyana or the Gulf while also funding a complicated ramp-up in Venezuela.
So they can walk and chew gum at the same time.
That's it. They don't have to bet the farm. They can monetize these new barrels without wrecking their balance sheet. If Venezuela works out, great. If it stalls, well, they have other assets.
So who fits this profile?
Well, obviously Chevron, ticker CVX. They're the ones making the comments. They're already on the ground. They've got that first mover advantage.
But they're not the only ones with that kind of scale.
No. You have to look at ExxonMobil, too. That's ticker XOM. Exxon has that same fortress balance sheet. They have that same ability to manage complex political risk. When markets open up that require that kind of heavy lifting, these are the two names that float to the top. They win because they're the only ones who can even get in the door.
That makes sense. It's a barrier to entry. Okay, let's move to the physical side of this. We say Chevron might ramp up production, but the infrastructure in Venezuela isn't exactly brand new.
It's been underinvested in for a very long time.
So if you want to get oil out of aging infrastructure, you're going to need help. Which brings us to our second group of winners, the oilfield services companies.
This is the practical side of the trade. We call it the reactivation phase.
And what does reactivation actually look like on the ground?
It's dirty, physical work. You've got wells that have been shut in, surface equipment that's rusted out. You need workovers, which is basically just fixing an existing hole in the ground so it flows again. You need new pumps. You need to repair pipelines.
You can't just flip a switch at corporate.
Not at all. You need crews. You need heavy machinery.
Yeah.
And the key for these service companies is they get paid first.
Okay.
Before Chevron sells a single extra barrel for a profit, they have to pay the service companies to come in and fix the plumbing.
So the cash flow for them is front-loaded.
It is. Every authorization to pump more oil is basically a purchase order for the service industry. And because of the complexity, you need the big global players.
So we're looking at the giants here.
You're looking at SLB, which used to be Schlumberger, ticker SLB. They have the biggest global footprint. They can get resources into difficult places faster than almost anyone.
Who else is in that group?
Baker Hughes, ticker BKR.
BKR?
And Halliburton, ticker HAL.
HAL.
These are the firms with the tech to handle a large-scale reactivation. If the supermajors are the architects, these guys are the contractors. And the contractors get paid when the work starts.
Okay, so we've got the oil coming out of the ground. Now it has to go somewhere. This brings us to the third group of winners, and this involves a bit of chemistry. We're talking about the Gulf Coast refiners.
This is a really crucial piece of the puzzle.
Why does a refiner in Texas care about oil from Venezuela? I mean, isn't oil just oil?
Oh, definitely not. Venezuelan barrels are what we call heavy and sour,
Heavy, meaning thick.
like molasses. And sour means it has a high sulfur content. It's nasty stuff. You can't just put that into a basic refinery. You need high complexity processing. You need cokers, hydrocrackers. Basically, you need $1 billion facility to break that sludge down.
And where are those facilities?
The U.S. Gulf Coast.
Yeah.
That entire refining complex was built decades ago, specifically to handle heavy, sour crude.
But Venezuela's been offline, so what have they been processing?
They've been making do. They blend lighter oils or they pay a premium for heavy oil from Canada. It's just not as efficient. Their systems are designed for the heavy stuff.
So if the Venezuelan spigots open up, these refineries get the diet they were actually built for.
Exactly. It improves their crude sourcing flexibility. In refining, your profit is the spread between what you pay for crude and what you sell the fuel for. If you can buy discounted Venezuelan heavy crude because nobody else can really process it and turn it into high-value diesel, your margins expand.
It's a comparative advantage.
It is. They have the hardware that the rest of the world lacks.
So which tickers are we watching in the refining space?
You want the complex refiners. Valero Energy is the prototype, ticker VLO.
VLO.
Then you have Marathon Petroleum, ticker MPC.
MPC.
And Phillips 66, ticker PSX.
PSX.
These are the companies that turn that difficult crude into cash. So that pretty much rounds out the winners. Supermajors capture the resource, service companies do the work, and complex refiners process the output.
Sounds like a pretty good setup.
Yeah.
But markets are rarely a win for everyone. Usually when one thing changes, it puts pressure somewhere else.
That's right. If supply increases, or even just the talk of supply increasing, that changes the pricing environment, and that creates headwinds.
Okay, let's talk about the first group facing those headwinds. You call them high beta U.S. shale.
These are the exploration and production companies, the E&Ps.
Can you explain high beta for us?
Sure. Beta is just a measure of how much a stock moves relative to the market. A high beta energy stock is like a sports car. When oil prices go up a little, these stocks tend to zoom up a lot. They're aggressive.
But sports cars can be tricky if the road gets slippery.
Exactly. These stocks trade almost entirely on the momentum of the oil price. For them to really work, you need a narrative of scarcity. You need investors to believe that oil is running out and prices are going to spike.
And Venezuela disrupts that narrative.
It puts a lid on it.
Yeah.
If the market starts pricing in this incremental supply from Venezuela, that scarcity premium just evaporates. The fear of missing out on oil goes away.
So even if these companies are well run, their stock price might stall because the macro story is gone.
Right. Investors use these stocks as a vehicle to bet on oil price spikes. If you take away the spike, you take away the reason to own the trade. They're pure plays on price direction.
So who are the names in this bucket?
You're looking to pure play E&Ps. Occidental Petroleum is a big one, ticker OXY.
OXY.
Devon Energy, ticker DVN.
DVN.
And Diamondback Energy, ticker FANG.
FANG.
Again, solid operators. But if Venezuela keeps oil prices in a range, instead of letting them spike, these stocks could lose their momentum.
Okay, that brings us to the second group of losers, U.S. land drillers. Now, this seems a little tricky. We just said service companies like SLB were winners. Why are U.S. land drillers losers? Aren't they in the same business?
Same industry, different focus. The global giants like SLB, they go where the work is. Venezuela, the Middle East, offshore. The U.S. land drillers are, well, they're largely tied to activity right here in the United States.
And the U.S. market is facing what you called short cycle sentiment issues.
Correct. U.S. shale is short cycle. You drill a well, it produces fast, then it declines fast. You have to keep drilling just to stay flat.
So why does the Venezuela news hurt them?
It comes down to capital allocation. If the supermajors, who are the biggest customers, start focusing their money and their attention on international projects like Venezuela or Guyana, well, that's money that's not being spent in the Permian Basin in Texas.
So the contracts go overseas and the U.S. drillers are left with less work.
Or at least the market expects them to have less work. Plus, there's this whole discipline narrative. The big oil companies are telling Wall Street they're going to be efficient. They aren't going to drill just to drill.
So if the big guys are being disciplined and looking abroad, the domestic drillers get squeezed.
That's the fear. Fewer rigs running in Texas means lower rates for these drillers. They're often the first stocks sold when investors get nervous about energy activity slowing down.
Who are the companies here?
Helmerich and Payne,
Hmm.
ticker HAP. They are the dominant land driller.
K-shape.
Patterson UTI Energy, ticker PTEN. And Liberty Energy, ticker LBRT.
LDRT.
These guys thrive when the U.S. is in a drilling frenzy. If the narrative shifts to efficiency and international supply, they can get left behind.
Okay, we've got one final category of losers, and this one feels the most counterintuitive to me. You listed offshore drillers.
The deepwater companies, yeah.
Usually when we talk about big international projects, offshore is the place to be. Why does Venezuela, which is an international story, hurt the offshore drillers?
It all comes down to the time horizon. Offshore projects are long cycle. We're talking billions of dollars in 5 to 10 years before you see a real return on that money.
So to invest in that, you need to be very confident about the future of oil prices.
You need to believe in a structural shortage of oil that lasts for a decade. You need to believe the world is running out of cheap oil, so we have no choice but to go drill in the middle of the ocean where it's expensive.
And Venezuela challenges that belief.
It complicates it. Venezuela has massive reserves. If that supply starts coming back online, it suggests that maybe we aren't running out of accessible oil. Maybe there's plenty of onshore oil just waiting for a political signature.
So it creates uncertainty. And if you're about to spend $5 billion on an offshore platform, uncertainty is a deal killer.
Exactly. It pressures the day rates, the price these companies can charge for their rigs. If the market thinks supply is loosening up, the urgency to drill deep water fades. That whole narrative that the market is tight starts to unravel.
So who are the offshore names that might feel this pressure?
Transocean is the big one. Ticker RIG.
REG,
Valaris.
ticker VAL,
VAL.
and Noble Corporation, ticker NE.
NE.
These stocks have had a good run based on the idea that the world is desperate for barrels. Venezuela just implies the world might not be quite as desperate as they hoped.
So, putting it all together, we have a very clear picture emerging from a single earnings report.
It's cause and effect. Chevron beats on efficiency and flags Venezuela. That signals opportunity for the supermajors, your CVX and XOM, who have the scale to handle it.
And it signals a payday for the global service giants like SLB and Halliburton who do the physical work.
And it signals better margins for the Gulf Coast refiners like Valero, who want that specific heavy crude.
But on the other side of the coin, it casts a shadow over the pure play U.S. shale names like Occidental, who need that price momentum.
It hurts the U.S. land drillers like HP, who rely on that domestic activity.
And it creates doubt for the offshore drillers like Transocean, who rely on a narrative of long-term scarcity.
It's a split screen. One headline, two very different outcomes depending on where you sit.
That's the nature of the energy market. Supply is never just supply. It's about the type, the location, and the cost to get it out of the ground.
Before we wrap up, I want to leave our listeners with something to think about here. We spent this time analyzing the moves based on Venezuela coming back online. But is it actually coming back, or are we just trading a ghost?
That is the provocative question, isn't it? The market is reacting to the potential of supply. We're seeing these moves based on management comments and some rule changes, not a flood of barrels hitting tankers today.
It's a sentiment trade.
It is, and it raises a really good question about pricing. How much geopolitical optionality is currently baked in? Are we trading the actual barrels, or are we trading the idea of the barrels? Because if the political winds change again, which in Venezuela happens often, this entire trade could reverse very, very quickly.
The idea of supply is sometimes more powerful than the supply itself.
That's often where the edge is found, understanding the difference between physical reality and market narrative.
A crucial distinction. We will leave it there for today. As always, a quick reminder to our listeners, please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for listening.
Until next time.